So guys, continue with cash flow. We'll do a small question, sir. Later on, we'll come back to few more concepts. 1, 2, 3. All these small questions we are done. Go to question number 5. In page number 17. Question number 5 ka goal is, sir, they have given you a P&L account. They also gave you balance sheets. 2 balance sheets they gave you. With the help of these, you are supposed to work out cash from operations. Not entire cash flow statement, only the first part of it. That too by doing direct method and indirect method. So let us see what they have given. Sales 5 lakhs, cost of goods sold is given. Admin expenses, depreciation, tax paid, loss on sale of assets, PBT, finally tax, and then you have profit after tax. So a normal looking P&L. Coming to balance sheet, last year, current year, shareholder funds, if you observe, last year it was 50,000, current year shareholder funds became 60,000. Don't get confused, sir. That is not completely share capital. Shareholder funds means in that reserves and surplus also is there. Normally in IPCC we are used to think that increase in share capital is inflow because shares might have been issued. That is correct now also. But what you are saying is not share capital. What you are saying is total shareholder funds. So you should have to be careful there. Next, non-current liabilities. Long-term loans decreased, maybe you have paid something. Current liabilities, creditors for expenses, provisions. Fixed assets, investment. Fixed asset compared to last year has increased in the current year. Okay, investment also has increased in the current year. Inventories decreased, debtors increased, cash increased by 1,000 total. That's also. The question is only this much. Now, you are not bothered about how much investment is purchased, how much liability is paid, how many shares are issued. You are not bothered about all that because the question ka primary requirement is only operating activities ka cash flow. So, you only bother about operating activities in both the methods, direct and also indirect method. Now you see the problem is they gave you sales. Sales, can you assume that entire sales is cash sales? You cannot assume that. Reason, in our balance sheet there are debtors also. Since debtors are there, definitely all the sales cannot be cash sales. There will be some amount of credit sales. Now how much is cash sales, how much is credit sales? A breakup is not given in the question. So, you don't have any choice other than to assume that all the sales are credit sales and somehow work out amount collected from debtors. How to collect amount, how to work out amount collected from debtors, sir? All IPCC single entry you are doing this only, no. Debtors opening balance is how much? 7,000. Closing balance is 10,000. Current year sales made is 5 lakhs. So, a gap whatever is there, how much is that? 497, huh? Yeah, 497. If 497,000 rupees represents the amount of cash collected, this will go into your cash flow from operating activities as a inflow. Likewise, when you see cost of goods sold, 3,50,000. Cost of goods sold ka formula what, sir? Opening stock plus purchases minus closing stock. That they gave it to you as 3,50,000. In this, opening stock, closing stock from the balance sheet you can pick up. So that is 13,000 plus purchases minus 12,000 is equal to 3,50,000, which means purchases will be equal to 3,49,000. Right? Now, can I say that all the purchases are cash purchases? We can't say that because you are having trade payables. Creditors are there. Here you see. As long as this creditor lives in the balance sheet, you cannot say that all the purchases are cash purchases. So definitely some are credit purchases. How much are credit, how much are cash purchases, data not there. So in the absence of no information, you have to assume that all the purchases are credit purchases and go and prepare a creditors account. When you prepare a creditors account, opening liability of creditors was 8,000, closing liability is 12,000, current year purchases are 349,000. So 345,000 is what the balancing figure is. What is this 345? Amount paid to suppliers or creditors. This will be an outflow under cash flow from operating activities. Apart from that, You can see what other expenses are there. Overheads is there 55,000. Now, ಈ overheads 55,000 expenditure, whatever you are seeing in P&L account, can I presume that it is completely paid in cash? For that, if you check the balance sheet, you see here, there is creditor for expenses. Last year outstanding is how much? 7,000. Current year outstanding is 10,000. That means, in a way, means you can prepare an account and work out also, or else smart thinking, 55,000 current year you incurred. Out of that 10,000 is still unpaid. That means, how much did you pay relating to current year? 45 to 10 is still unpaid. So how much did you pay? 45,000 you paid. But last year outstanding also you should have paid in the current year. So 45 plus 7,000. Total 52,000. 52,000 will be your outflow, sir. So you can check in the answer. 497, 345, overheads 52. These 3 items you took. Then depreciation is given in P&L account. Tell me, sir, will you deduct depreciation while working out cash flow? No. Interest paid only, but interest paid is which activity? Financing activity, so it won't come here. Loss on sale of asset is not a cash flow item. That is part of your inflow under investing activity indirectly, so we will not consider that. Tax given as how much, sir? 30,000. Now P&L whatever tax you see, that is tax paid, tax provision. A tax provision. What we want in cash flow statement is not provision for tax. What we want is tax paid. Now, e provision for tax paid, will it be same or not? And generally the answer will not be same. Tax paid is different. Provision for tax will be different. So how will you know how much tax did you exactly pay? For that you have to prepare a provision for tax account. So if you look into your balance sheet, liability side lo nowhere there is a tax provision, sir. Normal provisions is there, but tax provision is not there. Since tax provision is not there, we have to presume that whatever provision for tax you have created in your P&L account, that entirely is paid off. Because if that was not paid, that would definitely appear in your balance sheet as provision for tax. It is not appearing means entire 30,000 has been paid. So actual tax paid also is equal to 30,000. That means your items will be cash collected from debtors 497, cash purchases and amount paid to creditors, overheads paid 52,000, depreciation loss on sale you will not take. So by now only he got 1 lakh, from that 30,000 you remove, net effect answer is 70,000. This study material added question, sir. Of course, this is within your range very much, but still it's a newly added question. Originally study material it was not there, later on they added this. This is direct method. Now come on to indirect method. Okay, indirect method is much more easy, sir. Indirect method, what is your starting point? Profit. Actually speaking, it is profit before tax will be your starting point, sir. But anyway, see, profit before tax starting point, and who told him? He standard, there is no particular format for cash flow statement, but that's how we normally do. So here what he has done is directly took PAT and he finished off. That's okay, not a problem. Anyway, answer will be same. So PAT you take 53,000. While computing this PAT, thinking number 1, are there any non-cash items which you have to adjust? Who is non-cash in this entire story is a depreciation fellow is non-cash. So is 7,000 definitely we have to add back. Then, Emma? Yes, sir. Loss on sale of asset is also there. That also you have to add back. Next, interest paid is there. That might be cash, but that is non-operating. Even that also must be added back. So 3 items you added back. Then we have to go and do working capital adjustments. Working capital adjustments, why you have to do is, as discussed earlier, our sales low, some of the sales might not be collected in cash. Our purchases, some of the amounts might not have been paid. In your P&L account, opening stock, closing stock are there, they are non-cash items. All that needs to be adjusted. So for that working capital adjustments, if you do, come to your balance sheet, sir. Last year creditors 8,000, current year creditors 12,000. Creditor increased. Inflow now, outflow now. You have your own technique, no? Sir, inflow now, outflow now. Inflow, chalo. 4,000 rupees inflow add, sir. Next, creditor for expenses 7,000 became 10,000. Again inflow to the extent of 3,000. Provisions from 5,000 it increased to 8,000. So 3,000. Now you see provisions, which provision it is, and we do not know, sir. So this depending on that you have to adjust. But P&L account law, you don't see any item for provisions to be adjusted here. But maybe assuming that that is also related to your cost of goods sold or expenses, you can adjust that. But actually, there is no hint about that. So keep provisions aside. Next item, you have debtors, inventory, sir. Inventory from 13,000, it became 12,000. 13, if it is becoming 12, inventory is reduced. This is also a inflow for you. Next, debtors 7,000 became 10,000. Debtors 7,000 became 10,000, definitely is a outflow of 3,000. Cash, don't touch that. Okay, so that should be it, sir. If you check in your final answer, last point. PAT, depreciation, loss on asset, all this he added back. Working capital adjustments, 4 items are there. A 4K working capital adjustment he did. Finally, he got an answer of 70,000. The answer obviously should be same, sir. If it is not same, then you have messed up somewhere. So you have to go and check. In this, generally, indirect method, nobody will do a mistake, sir, because you might have done this many times in your past. Problem comes only with the direct method. People would have forgotten that. That fellow will ask only that. And our ledger accounts, debtors. See, he did working notes. Sales, add opening debtors, minus closing debtors, like that. You can prepare your normal ledger accounts how you used to do in single entry chapter. So that is about question number 5. Cheap one. Okay, question number 6. A firm invests in 5 years bond of another company with a face value of rupees 10 lakhs by paying 5 lakhs. Sir, a bond is there, a bond ka face value is 10 lakhs, but you invested it only at 5 lakhs. That much cheaply, why is anybody giving? Maybe that's a zero coupon bond, sir. You won't get any interest every year. Directly it will be redeemed at par towards the end. The effective rate is 15%. The firm recognizes proportionate interest income in its income statement throughout the period of the bond. That means you invested 5 lakhs only, but next 5 years, so nothing you will receive. 5th year ending, you will receive an amount of 10 lakhs. So every year, accounting, what will happen, sir? Investment account debit to interest income, and keep on writing for a period of 5 years. He is asking, based on the information, answer the following question. Number 1, how the interest income will be treated in cash flow statement during the period of the bond? Very good. In your P&L account, interest income naturally will be included. Correct? A profit low, that you have to remove it. Reason, it's a non-cash also, non-operating also. Interest income is which activity? Investing activity. And now that you have not received, that is non-cash also. One reason is enough for me to remove it from your operating activities, you remove it. You remove it here, but you cannot add this in investing activities. Why you cannot add? Because interest you are not receiving at the end of each year. No, that's why. So just remove it, that's it. Second, on maturity, whether receipt of 10 lakhs should be split between interest income and receipts from investment activity. See, today invested 5 lakhs. When I purchased a bond of 5 lakhs, it is outflow under investing activity. But after 5 years, I will receive 10 lakhs. Our 10 flow is inflow where? Our 10 lakhs is inflow where? This is receipt from where? Investment. This is also inflow under investing activity. He is asking, should I split them or not? Splitting in the sense, I invested 5 lakhs, now I got 5 lakhs, plus extra 5 lakhs also I got, that is nothing but the interest portion. Do I need to split and show? He is asking. Sir, whether you split and show or you don't split and show, either way both are going to come under investing activity. But if you split and show, it will be better for disclosure purposes as to understand how much is recovery of your principal investment, how much is interest income collected. So splitting and showing is not any bad idea, sir. It will only give you a better disclosure. So you can go ahead with that. So that is the answer for question number 6. Next, question number 7. Exclamatory has paid an advance tax amounting to 5,30,000 during current year. Out of the above tax, 30,000 rupees is paid for tax on long-term capital gains, under which activity the above tax will be classified in cash flow. Total I paid 5,30,000. No, if 5,30,000 low, 30,000 is exclusively related to capital gains. Capital gain means what? You might have sold an asset. Sale of asset is which activity? Investing activity. Therefore, capital gains tax also must be grouped under investing activity. Remaining 5 lakhs will be grouped under operating activity. Suppose you are unable to identify how much belongs to investing, how much belongs to financing, then go and throw entire thing into operating activity. Either I have discussed, but material I did not show you. I will show you after some time. Read this one. X Limited acquired fixed asset of rupees 10 lakhs from Y Limited. Okay, purchase of fixed asset by accepting liabilities of rupees 8 lakhs of Y Limited and balance amount it paid in cash. Carefully understand, sir. It's like I bought an asset from you worth 10 lakhs. Ideally, how much I have to pay you? 10 lakhs, no? What I did is, you owe money to somebody. I took over that liability. It is as good as paying consideration to you only, no? So, our liability worth is how much? 8 lakhs. But remaining 2 lakhs, I paid in cash. He is asking, how will you disclose this in your cash flow statement? That means 10 lakhs asset purchase, but cash involved is only 2 lakhs. 8 lakhs is a non-cash transaction, no sir. So, 8 lakhs will not be reported anywhere in your cash flow statement. Only at 2 lakhs must be shown under investing activity. But notes to accounts, it's better you go and give a disclosure. Because if you do not give a disclosure, people will think that you purchased an asset having a cost of 2 lakhs. That is not correct, no. You actually purchased the asset costing 10 lakhs. Hence, explanation in notes to accounts would be better. Next. An entity has entered into a factoring arrangement. This is newly added question, sir. 9th one. An entity has entered into a factoring arrangement and received money from the factor. Examine the said transaction and state how should it be presented in statement of cash flows. Simple, sir. I have debtors, no? If debtors I sold off to the factor. Factor gave me money. The question is, how will you account this? Under cash flow statement, of course. Okay. Cash flow statement, what will happen, we'll see later on. First you tell me, books of accounts, how will you do accounting for this? Factoring law. When debtors you sell to factor, what accounting will you do? Depends on? Good. Depends on whether risk and rewards are transferred or risk and rewards are retained. Imagine it's a recourse transfer. What does it mean then? Risk and rewards are transferred or retained? Retained. If risk and rewards are retained by us only, then debtor will derecognize or he will stay in the balance sheet. He will stay. But whatever money you received will be accounted as a liability. Now, think now in terms of cash flow. This money received, whatever you received, that is a liability. You yourself are telling that it is a liability. Liability lo money if you receive, what is the activity there? Financing activity. It's relating to debtors only, sale of debtors only. But you did not actually in substance sell the debtors because risk and reward still retain with us only. So since the debtor is not derecognized, you cannot call it as any operating activity and all. You have to go and show it under financing activity because this is a liability flow money received. Fine. Next, if it is a non-recourse factoring. Non-recourse factoring, what happens is debtor and I derecognize from my books of accounts. Debtor plus what is coming now? Cash is coming. Is it not like indirectly cash collected from debtors? Yes. So cash collected from debtors is which activity? Operating activity. So this also will be under operating activity. That means when you sell your debtors to factor, you have to see whether it is a recourse or non-recourse. Accounting the list, the cash flow is easy only. So that's about 9th one. It's an easy one, but newly added in the exam. Question number 10, I'll come to it later on. The IPCC question, sir. Okay, do one IPCC question, get insulted. Go to question number 12. The IPCC first question I used to teach. It's there in your book also. Don't behave like IPCC kids. From the following summary cash account of XYZ Limited, prepare cash flow statement for the year ended 31st March 2001 in accordance with IND AS 7 using direct method. What did he give you? His bank account, sir. So as we read along, you identify OA, IA, FA. Opening balance, which activity? Okay. Issue of equity shares. Financing activity. Receiving receipts from customers. Operating. Sale of fixed assets. Investing. Payment to creditors. Operating. Purchase of fixed assets. Investing. Overhead expenses. Any doubt whether that is paid or not? Bank account, sir. Okay. Payroll and employees benefit. Operating. Tax payment. No information is given. Operating. Dividend paid. Operating. Investing. Financing. Repayment of bank loan. Financing. Closing balance. That's all, sir. Now what you have to do is draw a statement. All OAs in one group. IAs in one group. FAs in one group. Our final net figures again you net off. To that add your opening balance. Naturally closing balance will come and you will get 5 rupees for this. Okay. Read this one. 13th one. Sir, if we cheap question, sir, so I'm not making you literally solve, but if you want, we'll solve. There's nothing like that. But they are straight IPCC questions, sir. One point new also will definitely solve. From the following data of Galaxy Limited, prepare a statement of cash flow showing cash generated from operating activities using direct method. Did you observe? IPCC every question was on indirect method. Here, almost third or fourth question we are seeing on direct method. Reason is the standard gives more emphasis on direct method. Anyway, so 31st March 2002 and that is 31st, why both the things are having same heading, sir? Wait a moment. Okay, one is 31st March 2001, which one is 31st March 2001? I do not know. Second one. No, both are same only, sir. That is, no, that's not inner column. That is P&L inner column. This is 31st March 2001, sir. You don't correct it, you hold like this only. After doing the sum, I will tell you. Okay. Inventory, trade receivables, cash and cash equivalents, trade payables, provision for tax. Points, whatever you see, inventory, trade receivables and all, they are prima facie working capital adjustments. But you will not understand them in terms of working capital adjustment because you are not doing indirect method. Indirect method just working capital adjustments. You are going to solve this sum only by direct method. So all this, how they help you is, P&L account sales will be there. Debtors opening closing is there. With the help of that, what will you do, sir? You will have to prepare a debtors account, understand how much cash is collected. For that purpose, you have to use them. Okay, anyway, come to P&L. Sale is given 85 lakh 50,000. Cost of sales is given. Again, same story, sir. Cost of sales ante, that is cost of goods sold. On the opening stock plus purchases minus closing stock. Above dabbalo opening closing stocks they gave you. Workout purchases. He purchase this creditors account lo you throw. Creditors account will give you cash paid to creditors. This is operating activity lo outflow you show. Next. Interest income. Nice. Fire insurance claim received 1,10,000. Now you see, interest income is definitely investing activity. You will not show it under cash flow from operating anyway. But fire insurance claim is there, no? Tell me, sir, receiving money from insurance company because of fire, is it my principal revenue generating activity? Yeah? No. This is definitely not investing also. This is not definitely financing also. But operating activity definition yesterday when we discussed, I told you, all principal revenue generating activities are operating activities. Any other activity which cannot be grouped under investing or financing also must be grouped under operating. Our quota this fellow will come off, sir. Who at 20,000, 1,10,000 will come off into cash flow from operating activities only. But since that is a little exceptional item or what you say, very infrequent item, you may give a separate disclosure for that. Depreciation, why will I touch or I will not touch? Admin and selling expenses is 15,40,000. Now, admin expenses related, any outstanding expenses are there and you have to check once. Since there are no such outstanding expenses in the balance sheet, you have to presume that 15,40,000 is totally paid in cash. Therefore, the operating activity. Interest expense is financing, don't touch that. Foreign exchange loss and non-cash, sir, don't disturb that. Finally, tax 95,000. Go and see, do you have any provision for tax in the balance sheet? Undiga sir, Mari. So, opening balance 65, closing balance 48, current year provision is 95. That means if I prepare a provision for tax account, 65,000, 48,000, current year provision is 95. 95. Go and work out this. You will get net adjustment 95 at 10, the 8, 1,12,000. This is your tax paid. Tax paid will be shown as a outflow under cash flow from operating it. So over sum. This 8 mark stuff, sir. Literally 8 mark stuff. Here some additional information is giving. That's as good as he doesn't give also, we'll do the same thing. He's saying that trade receivables and payables include amount relating to credit sales and credit purchases only. Japala sir, even if that line is not there also, we'll do that only. Tell me sir now, are you in a position to do trade receivables account? Debtors account and sir? This is opening balance, 31st March 2001 only. Correct it now officially. Debtors account is sir, opening balance, closing balance, sales, all sales, credit sales and you assume you will get the amount of cash collections from debtors. ఈ కాస్ట్ ఆఫ్ గుడ్స్ సోల్డ్ ఈ ఫార్ములా ఓపెన్ చేస్తే purchases will come. Assume that all the purchases are credit purchases. Put them into your trade payables account. Amount paid to creditors will come. Rest all are straightforward only. So total 3 accounts you have to prepare, sir. Trade receivables, trade payables, provision for tax. Remaining all are straightforward. Not your range actually. Okay. Now go back to theory, sir. 2 or 3 more points are there. First easy one will go. Go to page number 11. It's since already discussed with you, there is nothing much I have to do right now, but still, for the sake of it, I have to show now. This is components of cash and cash equivalents. That means, normally, once you present operating, investing, financing, net impact of all 3 activities, you will write. To that, what are you doing? Add opening balance of cash and cash equivalents. Result should be closing balance of cash and cash equivalents. Our cash and cash equivalents, so who are there? Cash will be there. Current account bank balance will be there. Highly liquid short-term investments not having a maturity exceeding 3 months from the date of investment, that will be there. All these, whatever you have to present a separate note explaining asal cash and cash equivalents and heading lo what are there. Sir, why is our note? Why note you have to explain is, e cash and cash equivalents lo movements whatever are there, they are prima facie not part of your cash flow statement. So readers must also understand cash and cash equivalent lo what cash items, what bank balances, what highly liquid short-term investments you have, adi explain cheyali sir, notes to accounts. So this is not related to your main cash flow statement. Notes to accounts, disclosure you have to give about the breakup in cash and cash equivalents. That is one point. Second, ee dabba sir. Dabba, I already discussed with you yesterday. What is this is, suppose you have a temporary bank overdraft. Temporary bank overdraft means, I'm not talking about books low overdraft, not that one. Genuinely only bank overdraft is there. I mean, there is a 50,000 balance. I issued a check of 80,000. So funds are not there, but still that fellow has passed on the check that resulted into a actual bank overdraft of 30,000 rupees. Now you ask me, sir, when will you go and pay this? Sir, normally, this type of bank overdrafts, why bankers will give is, prima facie we will have certain credit limits approved. Based on my past history, based on the securities what I have given to the bank, I have some credit limits approved. To that extent, I can take money from the bank. Means even if I issue a check of higher amount also, the bank will honor that even if sufficient funds are not there. Because anyway that money will be collected. And second thing, we also have given security to the bank. Now you come and ask me, sir, 50,000 balance is there. You gave a check of 80,000, but 30,000, when will you go and pay? It's like, 30,000 I need not separately go and pay. 30,000 naturally will become positive in the course of my activities. Like, tomorrow I make a cash sale, or there will be a receipt from a debtor. Our money also will directly go into that bank account only. 30,000 negative balance will again become 80,000 positive balance. So that keeps on fluctuating, sir. దీన్ని మనం temporary bank overdraft అంటాం. ఈ temporary bank overdraft, what did we discuss yesterday? It should be treated as part of cash and cash equivalents. So for example, 50,000 balance when you give a check of 80,000, indirectly, do you agree that banker gave you an amount of 30,000? Indirectly, yes. You should not treat it as a financing activities. I borrowed from bank and financing activities, so do not write that. It's part of your cash and cash equivalents flow movement. That means cash balance, current accounts, any balances, highly liquid short-term investments, bank overdraft negative. All this put together will give you your cash and cash equivalents. Just because you are presenting bank overdraft as a part of cash and cash equivalents while preparing cash flow statement does not mean that in preparing your balance sheet, bank overdraft, this cash and cash equivalents, you are not supposed to adjust. Bank overdraft in balance sheet will be treated as a pakka financial liability only. And accounting for that will come from IND AS 109 because of the financial liability. So don't bring e cash flow statement ka rule into your balance sheet presentation and accounting treatment. It is only for cash flow point. Adi ee box lo we have written. Bank overdrafts are included as component of cash and cash equivalents. Up to there we know already. A characteristics of such banking arrangement is that the bank balance often fluctuates from being positive to overdrawn, like the example I told you. Although Ind AS 7 permits bank ODs to be part of cash and cash equivalents for the purpose of presentation in the balance sheet, it would not be appropriate to include bank overdraft in the line item of cash and cash equivalents unless the netting of conditions given in Ind AS 32 are complied with. Of course, Ind AS 32 we have offsetting principles. Financial asset and financial liability can be offset. Unless our conditions are satisfied, you are not supposed to do any netting of bank overdraft separate to which also balance sheet lo. Cash flow statement purpose ki no problem, you can club it. The main point in this. Okay, there is one more point that I will tell you later on. Okay, coming to this point, go to 14th one, non-cash. Investing and financing transactions that do not require the use of cash or cash equivalent should be excluded from the statement of cash flows. Plant and machinery is there, purchased on credit. Plant and machinery is there, purchased by issue of equity shares, issue of bonus shares. All these stuff are purely non-cash activities. They will not come in your cash flow statement. However, somewhere else you got to give a disclosure for this, because normally people what they do is, when you give balance sheet, comparatives also will be there, no? Compared to last year, plant and machinery balance increase is there. From the balance sheet, it's very apparent that you have definitely purchased some asset. But when asset is purchased, what will this fellow reader do? He will go to cash flow statement. Investing activity, where is it there? And he will check. He will not find there. And he bought the asset, but it is not appearing. And liabilities, he will check. Okay, credit sir, credit purchase. No, vendor liability is not appearing anywhere. That means you bought an asset. Cash is not paid. Liability also not reflected. How should I understand this? You purchase an asset by issue of equity shares or accepting some, or by issue of some other instrument or something like that. It is non-cash, but it's not coming in your cash flow statement. So you have to give an explanation somewhere in your notes to accounts for all these non-cash transactions. Because when you present balance sheet, P&L, cash flow statement, there are entities, there are people who literally spend hours and days only on this report to reconcile and understand everything what is happening in your company. Because all the stock market, whatever movements are there, whatever inputs we get, year what happened, that what impact it has, why did this company has to borrow suddenly towards the end of the year, why monies are locked up, what is the impact of war on this company, everything will be sat and analyzed, sir. So you need to give a proper financial statement linking and explaining everything. So if something is not reflected in cash flow because it's a non-cash item, doesn't mean that the non-cash we'll ignore it. You ignore it while doing sum in the exam. But practically speaking, you have to give a disclosure for that. Our point he is telling. Such transactions shall be disclosed elsewhere in the financial statements in a way that provides all the relevant information about these investing and financing activities. They will not form part of cash flow statement. Examples: acquisition of assets, either by issuing directly related liabilities or by means of a lease, the acquisition of an entity by means of an equity issue or conversion of debt into equity. Bonds you convert into equity shares. Entry bond to equity shares or creditor to equity shares, but did not pay any cash for that, no? So it won't come anywhere. The non-cash. Now what else are there? Foreign currency cash flow effect is there. Taxes are there. Okay, let's first come to foreign currency part. 10th point. Okay guys, watch this. Sir, I have taken a loan of $10,000 at the beginning of the year. At that time, dollar rate was 50. So I recorded this loan in my books at 5 lakh rupees, initial recognition. By 31st March, which is my balance sheet date, $1 became 55. Since loan is a monetary item, all monetary items must be remeasured using the closing exchange rate. Closing exchange rate remeasured. This process we suffered a exchange loss of $10,000 into rupees 55 minus 50. So that is a loss of 50,000 rupees. E-loss, happily I have debited it to PRL. Fine, sir. Now I am preparing cash flow from operating activities. If you are preparing cash flow from operating activities using direct method, no sir, then there is no problem. Why? You will simply not take this. P&L 50,000 will be there. You will say non-cash, no, it will not come. You will not even consider this. All the problem comes when you are preparing under indirect method. You will, starting point will be profit, a PBT generally. A PBT when you start, a PBT calculation already 50,000 has been deducted. But tell me sir, to that extent, do you have a cash outflow? Do you have a cash outflow to that extent? Why no cash outflow? This is a valuation loss, sir. ఒక లైబిలిటీని క్లోజింగ్ ఎక్స్చేంజ్ రేట్కి యూ రీమెజర్డ్. ఈ ప్రాసెస్లో లైబిలిటీ వాల్యూ ఇంక్రీజ్. బట్ డిడ్ యూ పే దట్ టుడే? యూ డిడ్ నాట్ పే. అంటే ఈ 50,000 incremental in the liability is coming as a loss in your P&L, but for that there won't be any cash flows. Since there are no cash flows for that, you are going to simply add it back because it's an exchange loss. If it is an exchange gain, I would have removed it. Basically, unrealized exchange gains or unrealized exchange losses which are there in your P&L account, they are non-cash కాబట్టి you definitely have to eliminate them. ఈ point I need not give an example. Casually if I tell also exchange loss, you obviously is a non-cash item, you definitely have to eliminate that. Okay, this is one example, sir. Look at another example. This is my balance sheet, sir. At the beginning of the year, I went and invested $100 in foreign currency bank account. Whether it is local bank or foreign bank, either way, bank balance is cash only, no. So $100 invested. When I invested, its dollar rate was 50. So this I represented at 5,000 in my books. First day, fair enough. Come to balance sheet at end of the year, where exchange rate became, where did I 55, like 60 only. So what I have to do, sir? You must understand, foreign currency bank account is also monetary item only, because monetary item itself is money, sir. Money and receivables are payables in money. So money itself is monetary item. So pakka you have to register, there is no choice. So foreign currency bank account, which is part of my cash and cash equivalents, representing $100, I multiplied this now with $1 is equal to rupees 60. So this is now appearing at 6,000. Tell me what entry I would have recorded for this? What entry I would have recorded? 5,000, 6,000 in, sir. What entry I would have recorded in the background? Foreign currency bank account, I updated by how much? 1,000. And I would have recorded a exchange gain by creating my PRL to the extent of 1,000. This is an entry, sir. Imagine that in your P&L account, apart from this, one item also not there. That means your profit before tax is exactly 1,000. Yes, sale, purchase, inventory, expense, nothing is there. అది ఏం చేయలేదు సార్, జస్ట్ ఒక $100 FC బ్యాంక్ అకౌంట్లో వేసాడు అండ్ ఈ సాట్ లైక్ దట్ వితౌట్ డూయింగ్ ఎనీథింగ్. 1,000 rupees ప్రాఫిట్ కేమ్ P&L. నౌ యు ఆర్ ఇన్ ద ప్రాసెస్ ఆఫ్ ప్రిపేరింగ్ cash flow from operating activities. Imagine investing activity, financing activity also zero. You tell me what I have to do now. 1,000 is what? 1,000 is purely exchange gain. Realized or unrealized? Unrealized. Realized, and when will you say, sir? Debtors, sir. Debtor foreign currency debtor is there. Dollar rate increased, debtor balance also increased, exchange gain came. Realized or unrealized? Unrealized. When will it be realized? When we collect cash. In dollars or in rupees? In rupees, so you have to collect. That means he will pay dollars only. When you convert that into rupees, then only exchange gain is realized. Until then it is unrealized. Answer this. Realized or unrealized? Realized. Realized. That is already in bank. Where 6,000 rupees is in your bank account. $100 ante still in dollars only, no. Sir, that is related to bank account. Don't get confused. Adi bank account, but that is not realized. Sir, if that is only realized, it would have been realized at this stage also. Then why would I go and do restatement of this? Suppose, sir, realized means hereafter forex fluctuations are not supposed to impact you. Appudu realize antam, sir. Debtors un sir, $100 evolving. He gave it today. You received it. You converted it. Hereafter, dollar increasing, decreasing, will it impact you? No. Adi realization ante. Here, adi bank account. Which bank account? Foreign currency bank account. You tell me if that money fell in your home currency bank account. At that time, I will call it as realized. Today, realized or unrealized? Unrealized. Just because it is bank account, don't fall in that trap, sir. It looks very convincing that it is bank account now. No. And you think that is adjustment? No, sir. It is pakka unrealized. Unrealized number ఏం చేస్తాం సార్? తీసేస్తాం. Exchange gain unrealized. 1,000. Fantastic. This became how much now? 0. There are no other adjustments, I told you, no. This is your cash flow from operating activities. Imagine cash flow from investing activities 0. Cash flow from financing activities also 0. So net increase or decrease in cash and cash equivalents also 0. Yes, sir. Last, what you have to do here? You have to add opening balance of cash and cash equivalents. If you add this, what should you get? Closing balance of cash and cash equivalents you should get. What is the opening balance of cash and cash equivalents? 5,000. Add this answer. Answer is 5,000. Here comes the problem. A closing 5,000, sir, that won't match with your balance sheet closing balance. Did you understand the problem here? The problem is not that is unrealized, unrealized day. That unrealized out non-cash. Non-cash and I removed it. The moment I bloody remove it, a closing cash balance, what comes in your cash flow statement, will not agree with the cash and bank balance as per your balance sheet. A difference is just, sir. What should I do now? BRS is not for that. But idea is right. BRS lo R is correct. What is R? Go and do a reconciliation. Go and do a reconciliation. That means E statement up to here correct only, but don't stop here. Ikkada తీసుకెళ్ళి add exchange gain, loss అయితే minus చేసుకోవాలి సార్. Exchange gain on cash and cash equivalents 1,000. This will give you 6,000. This is as per your balance sheet cash and cash equivalents. Sir, why to do all this, sir? It's better we ignore, no? If you ignore it, naturally it will tally. I want to assume that bank account related exchange gains or losses are as good as realized gains or losses. If I assume that, most of you told that answer, no? If I accept that, actually 1,000 I will not remove only here. Here answer will be 1,000. Here also answer will be 1,000. Here 5,000 add just a closing nicely, 6,000 will come. But that is wrong. That is wrong. Why is it wrong? 1,000 rupees is a unrealized gain. See, unrealized ki realized ki difference simple sir. Realized means a hereafter exchange gain should not touch me. Appudu realize antam. Here, tomorrow if dollar rate becomes 62, you will be very happy. It becomes 57, you will be sad. So dollar fluctuations are still impacting your cash flows. It's unrealized. Just because it's foreign currency bank account doesn't mean that it is realized. So understand the case correctly, sir. When you have a foreign currency bank account like this, this will have an impact on your P&L account, but still there is unrealized. You remove that. Removing is correct. Reason is simple. Reason is non-cash. Ikkada removing correct. But because you removed something related to cash and cash equivalent, pakka ee cash flow statement ka closing balance will not match with your balance sheet balance. Andukani you have to go and give a reconciliation here. You don't believe, this is an 8 marks question in the exam. Ive numbers, sir. Same adjustment. 8 marks. You cannot afford to leave standards like this. If it's cheap standard, easy standard, and I keep it towards the end, not because they are less important. Big standards originally we finish off, but this is not any waste standard and all. This question came for 8 marks, sir. Free marks. Okay. So that's all is given here. Then there's one more point, I'll tell you that later on. Go to 11th one. Sir, whatever I'm keeping in pending, I will again consolidate, sir. Entire standard I'll take you through once. It's like for certain cases, you need proper numbers and background. So slowly I'm setting up. Interest and dividends, sir. Normal rule, sir. Interest paid which activity? Financing. Dividend paid? Financing activity. Interest received? Investing. Dividend received? Investing. Now imagine you are a bank or a financial institution. Interest paid? Operating. Interest received? Dividend received? Dividend received also operating only. Reason, banks, NBFCs, these people whatever cash they have, they cannot hold idle cash. Means they'll have cash obviously idle, but liquid cash they'll have, but entire cash they won't keep it liquid. No, somewhere they have to invest. When they invest only, obviously they will get interest income and dividend income. That's part of their core operations. Investments is. So even dividends also is a operating activity if you are a financial institution. Dividend declared to your shareholders. Adi financing. There is no doubt on that. Dividend declared for any company, it is always a financing activity. It's a bank or not a bank. So that is 11th point I wrote. 12th point I already discussed it with you. Cash flows arising from taxes on income shall be separately disclosed and shall be classified as cash flow from operating activity, unless they can be specifically identified with financing or investing activity. Our next paragraph you not read, sir. He is simply saying that sale of asset happened in this year. Related tax you paid in the next year. So, like if one transaction you can identify, many transactions are there. If many transactions are there, every year you sitting and working out E tax, E amount belongs to E transaction like that, detailed information may not be there. So it is nothing wrong to group entire amount under operating activities. However, when you have a clear information, you can go and put it and classify it appropriately. Operating at operating, financing at the financing, investing at the investing. That's paragraph he told. Here you see. Cash flows arising from tax. If you see, everything is covered in this. Cash flows arising from taxes on income shall be separately disclosed. And when it is practicable to identify, put you classify it as investing or operating. Not practicable, happily classify it as operating activity as appropriate. Okay, then it comes to subsidiaries. Okay, let me finish up one more. Someone last adjustment will keep that. Come to 10th one. This is exactly the sum what I just now discussed with you. An entity has a bank balance in foreign currency aggregating to $100, which is equivalent to 4,500. $100, how is it equivalent to 4,500? Exchange rate is 45 rupees. Presuming no other transaction taking place, the entity reported a profit before tax of 100 on account of exchange gain on the bank balance in foreign currency. That means, in the current year, if 4,500 rupees worth of $100 is there, no, that became 4,600. Accordingly, there is an exchange gain of 100 rupees. That is your only item, it seems. There is nothing else other than this. Sir, why this should be only items, sir? If many other items are all there, then answer will be different. No. Even if 1,000 items are there, answer will be same only. Only thing is, if only one item is there, you will be able to easily understand the impact of that. That's why only one item they keep. He is asking what would be the closing cash and cash equivalents as per balance sheet. Now, as per balance sheet, answer is 4,600. But while preparing cash flow statement, observe, you started with PBT. From that, you removed unrealized gain. Cash flow from operating activities became 0. Investing is 0. Financing is 0. Net increase in cash and cash equivalents also 0. To this opening balance you added, you will get again the same opening balance as your closing balance. But this won't agree with your balance sheet cash equivalents. So here he is again presenting a reconciliation. If you do not give this reconciliation, it won't match. It won't be nice. Okay. Then I'll take another case, sir. This I'll first take, later on let's try to answer that. Sir, imagine that in the current year, beginning, nothing is there in your entity. Means no assets, no liabilities, nothing. Everything is cash, all stock sold out, atla anukondi sir. Operating activities, nothing is there in the balance sheet, opening. During the year, you made a purchase of goods. That to dollars you purchased. When $1 is equal to, let us say, 50. So you would have recorded entry of purchase account debit to creditors at what value? 5 lakhs. Coming to year end, here. Closing exchange rate, $1 is equal to 45. So there is an exchange gain. How much gain? 5 rupees per dollar into $10,000. 50,000 rupees exchange gain is there. Closing creditors will now be equal to 4,50,000. And during the year, one transaction also did not happen, sir. Okate transaction happened. What is that? Credit purchase of goods, that two foreign currency supplier which we bought, and nothing else happened. Sir, Mara goods, what happened to that goods? They are laying in the stock. I did not sell it. Nothing happened in the current year, sir. Tell me, how much will be your profit? Sir, this is not related to cash flow. Common sense. Cheppandi, sir. How much will be your profit? 50,000? Or purchases 5 lakhs ఉంది కదా సార్, P&L కేరా ఏం సార్? పర్చేజెస్ 5 lakhs ఉంది కదా, P&L లో రాస్తారా రాయరా సార్? సార్, మరి ప్రాఫిట్ 50,000 ఎట్లా వస్తుంది? Good. Purchases you will record 50,000, but closing stock also you will record 5 lakhs. Sorry, purchase you will record 5 lakhs, but still since stock is unsold, e 5 lakhs will also become the value of your closing stock. Therefore, 5 lakhs purchases you record, closing stock 5 lakhs you record, profit, gross profit will be 0. But exchange gain 50,000 is there, that you have to record. Now, your profit before tax is 50,000, sir. Now I am preparing cash flow from operating activities. You tell me what adjustment I have to do. What adjustment I have to do? If 50,000 whatever is included in your profit, in this exchange gain is there? Yes. Are they realized or unrealized? Unrealized. Unrealized got what I should do? Add or minus, sir? Are they doubt on that? The exchange gains are already included in PBT, so you have to minus. Okay, exchange gain minus chesedam, sir. How much is that? 50,000. Okay. What about working capital adjustments? Nothing, sir. No change. No change. How can there be no change? Creditor is there? Current year creditor is there? Last year creditor was there? No. Current year ending to creditor is there? Increase in creditor. Increase in creditors. What is this? Outflow now, inflow now. What is this? Inflow. How much inflow? 5 lakhs. Huh? Okay. Then stock. Increase in stock. How much increase in stock? 5 lakhs minus. Net impact is 0. Sir, do you agree with this answer? All of you. Okay. Now, come back to your material forex related point. Wherever forex related point is there, go there. In that, I skipped up one item wantedly. Adoka presentation effect, sir. Where is that fellow hiding? Page number 6. Read this correctly. Under indirect method of preparation of statement of cash flows, the exchange differences. Okay, 1 minute. Heading you read once. Treatment of exchange differences arising from unsettled transaction. Unsettled means credit purchase A, amount not paid. Credit sale A, amount not yet received. R type. Exchange differences related to unsettled transactions. Ante unrealized gains A, but related to operating activities. One extra point is telling. What is that extra point? Let's see. Under indirect method of preparation of cash flow statement, exchange differences that arise on translation at the balance sheet date for monetary items that form part of operating activities will require no adjustment in reconciliation of profit to net cash flow from operating activities. You know what is he saying? Don't touch exchange gain or exchange losses relating to operating items. అంటే నీ P&Lలో unrealized gain is there. Don't remove that. నీ P&L unrealized loss is there, exchange loss. Don't add back that if they are related to operating items. Don't touch that. Sir, but if I don't remove this, why the hell will the closing balance tally? ఇప్పుడు నీ ప్రాఫిట్ క్యాల్కులేషన్ ఒక నాన్ క్యాష్ ఐటమ్ ఉంది సార్, ఎక్స్చేంజ్ లాస్, అది రిలేటెడ్ టు క్రెడిటార్సే. బట్ ఇఫ్ ఐ డోంట్ ఎలిమినేట్ దాట్, హౌ విల్ ద ఫైనల్ క్యాష్ ఫ్లో స్టేట్మెంట్ టాలీ విత్ యువర్ క్లోజింగ్ బ్యాలెన్స్? It will tally. Go back. Watch this data very clearly. You purchased goods worth how much? 5 lakhs. Exchange rate at the time was 50 rupees. At the end of the year, exchange rate became 45. 45, what did you do? Exchange gain 50,000 you booked. That became also gain in your P&L. Closing rate has become 4,50,000. You told that PBT 50,000 sir. A 50,000 exchange gain is there 50,000. Adi unrealized, so we will remove it. Chalo, remove it. Increase in creditors, you told 5 lakhs. Increase in stock 5 lakhs. Idi general thought, sir. In fact, I am surprised. Many of the examination questions also they tried to do in this pattern. But IND AS 7, what it asks is, you have PBT 50,000. In this, exchange gain is there, but that is related to an operating item. Don't remove that. Don't remove that. Let it stay. Sir, but non-cash, no, let it stay. Directly come to working capital adjustments. When you do working capital adjustments, increase in creditors. Last year creditor is 0. Current year creditor is how much? Year end it became 4,50,000. Adi raseyandi sir ikkada. Increase in creditor is inflow or outflow? No? Inflow. Sorry. Increase in stock minus 5 lakhs. Net impact still 0. What you told is not wrong. Adi correct. Idi correct. Kani idi IND AS 7 requirement. Exchange gain or loss unte normally it's our habit to go and add it back or remove it from the PBT. He says don't do that. Don't do that if that is relating to a operating activity. Ante oka debtor ko creditor ko expenses ko related item unte don't touch that. So then how will you remove that? That automatically will be removed. Automatically it will be removed. When you do working capital adjustment, so it will get removed. Are you understanding, sir? Here where you should be careful is, in case you adjust this, it could increase in creditors without taking exchange effect you have to handle. Because you could remove your service and exchange gain, it's as good as you have not recorded only. If exchange gain you have not recorded, creditors will be appearing at 5 lakhs. 5 lakhs there. Appudu match out, sir. Ante even if you do wrongly like this, answer will come only when you remember that point. Adi wrong by anyway. You are not bothered about this. You will have to do this. Idi IND AS 7 requirement. I am quite surprised. There is a question in MTP, 2 times MTP question. That fellow did not do like this. He did it like this. That's wrong. What can we do? See, whatever you are seeing here, you can see the text also. That's not my text. Study material text. The original bare IND AS 7 like that taken and copy pasted there. Idi correct, sir, whatever I have taught you now. So any exchange gains or losses unrealized relating to your operating activities included in P&L, do not eliminate them. Sir, my unrealized, now how will it go? Naturally it will go, sir. When you do working capital adjustments, it will automatically get eliminated. That's what feeling. Because suppose this exchange difference I did not record, then also you are happy, no? Cash flow point of view. See, adjustment and all, why is it coming into picture? Because I recorded a unrealized gain, adega any problem. Just imagine I did not record, sir. Had I not recorded, what would have been my PBT? Had I not recorded any exchange gain, my PBT straight away would have been 0. My closing creditors straight away would have been 5 lakhs. My stock closing would have been 5 lakhs. PBT 0 kada. So addition minus nothing is there. Straight I will go and do working capital adjustments. Creditors increase plus 5 lakhs jastan, sir. Stock low increase minus 5 lakhs jastam. Ultimate ga answer will be 0 here also. In which case I am talking unrealized gain is there, but I did not record only. When you do not record, automatically whatever you want, I effect will come. But how can I not record? I will record. Accounting, no, why will I not record, sir? I have to record, no, I recorded. Because I recorded, what happened is, idi 50,000 perigin, sir. This naturally decreased by 50,000. So even if I don't do anything also, that will still become 0. Your standard is exactly saying that, don't do anything. Don't do anything. If you don't see, did I do any special treatment here? Did I add back exchange loss, minus exchange gain? Nothing. Just leave it like that. Aram se wait. That naturally will become 0. The effect naturally will get adjusted. Adi our standard ka goal. Important point, sir, but they messed up in one sum. Okay. Go to that question there. No. Go to question number, wait, I don't know. Question number 20. 20 is a good question, sir. But E particular sum lo, whatever point I just now told you, they messed up that point. But for that, it's a good question. Now, how far chances are there in the exam, I do not know. But MTP lo there, I copied. I'll give you my version of answer also for this. Read. A Limited, whose functional currency is Indian rupee, had a balance of cash and cash equivalents of 2 lakhs, but there are no trade receivables or no trade payable balances on 1st April 2001. So year beginning balance is 2 lakhs and nothing else is there. Working capital items are not there. During the year 1-2, the entity entered into foreign currency transactions. A Limited purchased goods for resale from Europe for euro 2 lakhs when exchange rate is 50. This balance is still unpaid on 31st March 2002 and the exchange rate became 45. So 50 rupees became 45. There is an exchange gain of how much? How much? 5 rupees. 5 rupees. An exchange gain on retranslation of the trade payable of rupees 5 lakhs is recorded in PRL. Now how come this will be only 5 lakhs and I am worrying, sir? Because 50 became 45 means the gain is 5 rupees per euro. How many euros are you having? 2 lakh euros. So that should be 10 lakhs. Okay, that mistake we will handle later on, or else that should be 10 lakhs only. Let me check once later on. Let's go further. We'll see. That can be a mistake also. A Limited, so this is a transaction, sir. Second transaction. A Limited sold the goods to an American client for $150 when the exchange rate was 40. The amount was settled when the exchange rate was $1 is equal to 42. It is settled, sir, not unsettled, realized. A further exchange gain regarding the trade receivable is recognized in PRL. How much gain is this? 2 rupees per dollar into 1,50,000. So totally it will be 3 lakhs. That is fine. Next. A Limited also borrowed 1 lakh euros under a long-term loan arrangement when the exchange rate was 1 euro is equal to 50 and immediately converted into 50 lakh rupees, obviously. The loan is retranslated on closing date at 45. So 1 lakh into 5 rupees gain. So further exchange gain of rupees 5 lakhs. Go to first point, sir. Please make this 10 lakhs. This is printing error. Maybe that's the reason the question did not come. So tell me only the gain, sir. Eat 3 transactions. First transaction lo gain is how much? 10 lakh. That one he only gave. No. Second transaction lo 3 lakhs. Third transaction lo 5 lakhs. Total exchange gain 18 lakhs. Read fourth point. A Limited therefore recognizes a cumulative exchange gain of 18 lakhs in arriving its profit for the year. The current year profit calculation lo he booked an exchange gain of total 18 lakhs. 18 lakhs how it came and you already know. I'm not talking about that. Continue. In addition, A Limited records gross profit of rupees 10 lakhs on the sale of goods. So during the year, some sale of goods happened and sale of goods low, you made a profit of some 10 lakh rupees. Nice. Ignore tax. How cash flows from the above transactions would be reported in statement of cash flows under indirect method. Okay, don't read the answer. Think. If you have to apply indirect method, what is your starting point? Profit into gross profit, net profit, net profit, that too profit before tax you have to take. This fellow did not give any tax, so just take the net profit before net profit. So net profit, where is it there? Gross profit ki P&L items also you add off now first add off and later on again we'll remove that. So how much is GP? 10 lakhs. P&L how much is exchange gain? Overall you booked 18. 10, 18 kalpesend sir. Total 28 lakhs. 28 lakhs will be your starting point. Okay. Next. Now think. 28 lakhs. So where do you have problems? 10, 3, 5, all 3 are problems only. No. 3 lakhs is not a problem. Why? As realized kabatti. There is no problem with that. Sir, then problem is there with 10 and 5. Correct. Actually, because 10 is also unrealized, 5 is also unrealized. Since they both are unrealized, what I should do? I should eliminate them. You see, that fellow exactly did that. He removed 10 and 5. Okay, now let's understand what he has done. So he got that. Working capital changes. Working capital changes low. If you observe, last year beginning creditor is not there. Current year creditor is there. Whatever creditor got created, that he booked here. Whatever creditor got created, a creditor he wrote there. Ultimately got some answer there. But here the problem what he has done is, the problem where this fellow has messed up is, e particular 10 lakhs item is there, no? A 10 lakhs item is a operating item. Operating item related foreign exchange gain, foreign exchange loss should not be adjusted while doing cash flow statement indirect method. You leave it like that, trade payables closing the when you match, automatically it will be adjusted, sir. You need not do that. Anyway, he did that. So that is the problem there. But ultimately, even if you do also, it will tally. If you don't do also, it will tally. But not doing is correct. He did it. Next. Sir, changes in working capital, he wrote 50 lakhs. How did he get that? Some mistakes are there, I guess. 50 lakhs, how did he get change in working capital? Closing debtors are not there, sir. Already corrected. Okay. Borrowing is not working capital adjustment. Forget about that. Coming to first item only, 1 lakh, $2 lakh into 45. $2 lakh into 45 is 90 lakhs. He recorded that as 50 lakhs increase in trade payables. Okay, wait a moment. Emma? Long term loan is a working capital adjustment. Since when? Okay. Emma? I'm checking. Gross profit low they gave, observe closely. Gross profit low 60 lakhs minus 50 lakhs and he gave you. Ante what is that 50 lakhs? That is apparently purchases, sir. Purchase means cost of goods sold of 50 lakhs. That means out of 100 lakhs creditor what you have, 100 lakhs goods what you purchased, in this half are sold. If half are sold, how much is the balance inventory? Sir, 100 lakhs goods you purchased, half you sold. Sir, how do you know half is sold? See here, 50 lakhs is sold. The sale price is the cost price. So how much is remaining, sir? 50 lakhs. This is increase in inventory, 50 lakhs. Increase in inventory is a minus. Increase in creditor is a plus. That stupid wrote net amount there. due to changes in working capital. Brackets, what is the reason he gave you? Increase in trade payable answer. That's not increase in trade payable alone. Increase in trade payable, increase in stock also. Are ended net effect రాశాడు సార్. ఈ sum చేయాలి సార్. Sum is wrong basically in your notes. ఈ sum లో one big mistake is there. What is that mistake? ఈ 10 lakhs the problem is there. 10 lakhs the problem is there. Right sir in your notes. I have clearly standard is prohibiting. How can you do that? Right sir, only one working note is there. What is the question number? 20. Okay. In the current year, the following exchange gains are recorded in PRL. In that first one, unrealized exchange gain on creditors is equal to 50 minus 45 into 2 lakh euros, that is rupees 10 lakhs. Though it is unrealized, it should not be adjusted to net profit while computing cash flow from operating activities under indirect method, as it relates to operating activities which are unsettled. So 10 lakhs ni minus చేయడం అనేది not right sir. You should leave it like that. Closing value of trade payable, or else one second. Right like this. Value of stock purchased and the liability recognized is equal to 2 lakh euro into rupees 50. Please tell me the value. 100 lakhs. So 2 lakhs into 5 is 10 lakhs. 100 lakhs. At the end of year, ఈ సమ్లో ఇదే మెయిన్. ఈ వర్కింగ్ నోట్ అయిపోతే there is nothing else. At the end of the year, balance of stock in inventory, 100 lakhs you purchased. Out of that, 50 lakhs is cost of goods sold in current year. Some point it's there, go and check. 50 lakhs. Balance of creditors. Creditors value 2 lakh euro, but it is remeasured at 45 rupees. So that should be rupees 90 lakhs. Second adjustment. Second adjustment is realized exchange gain relating to sale of goods. If these small adjustments are, they'll come for good marks. Like easy pickings example, 3 lakhs. No adjustment is required since it is realized and also operating in nature. Above point unrealized, still nothing is required. It realized, still nothing is required. Reasons different. It realized కాబట్టి I'm not doing anything. అది unrealized and I won't do anything because it is operating item. I effect naturally will get nullified when I do working capital adjustments. So reasons are different. Anyway, ignore it. Working capital adjustments. Sorry, cash flow statement. Third point. Third point is loan related. Exchange gain unrealized on long-term loan is equal to ₹5 lakhs. To be adjusted. E 10 lakhs is gross profit, sir. To this E 18 lakhs exchange gain also, if I add, my P&L account must be reflecting 28 lakhs PBT. Put that in the statement of cash flow. Starting point is PBT 28 lakhs. Don't see what they have done. They have committed a mistake there. Add unrealized, not add, minus unrealized exchange gain on foreign currency long-term loan. How much is foreign currency long-term loan related? 5 lakhs, huh? 5 lakhs. 5 lakhs any problem. Handle that. That's it, sir. Net of this 23 lakhs. This is operating profit before working capital adjustments. Working capital adjustment అయ్యే వరకు you should not use the term cash flow. అది still profit. Once you do working capital adjustment, it becomes cash flows. in this. Increase in creditors 90 lakhs, closing, opening loss 0. Increase in creditors is a inflow. Then increase in stock. Year beginning the stock is not there, but now we have a stock of 50 lakhs. Increase in stock is an inflow or outflow? Outflow. Some tax is not there, so net of this. So the 40 effectively, 40 plus 23, 63 lakhs. This is net cash inflow from operating activities. Second, cash flow from this is not there but still right. Investing activities nil. Number 3, do you have any financing activities? Which one? Amount received, loan you have taken, no? He also borrowed amount, clearly wrote. Cash flow from financing activities. Long-term loan raised. You borrowed, converted into 50 lakhs and directly is giving away to again. I will do conversion. I'll copy that. 50 lakhs. So that's it here. $50 lakhs itself is your net cash inflow from financing activities. Net increase in cash and cash equivalents is 63 lakhs plus 0 plus 50 lakhs. 130, no? 113 lakhs. To this add, question ka first paragraph please. Opening balance of cash and cash equivalents. How much is that? 2 lakhs. How important presentation is, if you do not know this, you will get entire marks gone, sir. At 10 lakhs, even if you add back also, answer will be 63 lakhs only. But you should not add. That's a note point. Guys, pick up 19th question. Following is a balance sheet of Kuber Limited for the year ended 31st March 2002. So they gave you literal Schedule 3 balance sheet there, 2002 and 2001. PP, observe each line by line item, sir. Go and observing the changes. PP last year 12,500, current year it became 13,000. So there is an increase. Definitely there is a purchase. But you cannot say 500 rupees is purchase because there can be some sale also, there will be depreciation also. So you definitely have to go and prepare a PP account. Coming to intangibles, last year 30, current year 50. Definitely there is a purchase, but intangible asset means amortization also will be there. Other financial assets, 170, it became 145. Reason, do not know. Continue. Deferred tax asset, DTA compared to last year has increased in the current year. DTA, why will it increase, sir? You would have created DTA. When you create DTA, The entry you write is DTA account debit to P&L, but there is no cash inflow. So DTA creation is a non-cash item, sir. You have to minus that. Other non-current assets, that's okay. Financial assets, current assets low, investment is there, investments decreased, definitely sale is there, or write-off of investments also is possible. Cash and cash equivalents also change is there, other current assets are there. Coming on to the liabilities side, equity low no change, other equity low change obviously will be there because there will be some profit. Long-term borrowings have decreased, so some repayments happen. Other non-current liabilities low also change is there, so you might have paid something. Financial liabilities, trade payables increased, bank overdraft has increased, other current liabilities also increased. So total current liabilities and all he gave you. Then extra adjustments are profit after tax for the current year is 4450. Already profit after tax he gave you, sir. Pat, you not work out that. But even if they don't give you that, we will be in a position to work out in some other way. Then interim dividend paid during the year is given. Sir, imagine if that fellow does not give you profit after tax, how will you work out that? Go to other equity. From 8,000 this became 12,000. Until retained earnings increased by 4,000. If retained earnings increased by 4,000, you cannot say that is current year PAT. That's pakka current year profit. But retained earnings also further adjustments also can be made, like any interim dividend and all. If somewhere there is a dividend, how much is the dividend? 450, yeah? 450 you add back. Now you will have 4450. That's profit he gave you in the first month. So even if a first month is not there, you should be able to work out your PAT. Next, depreciation and amortization charged in P&L during the current year are as under. Depreciation PPE ki 500, intangible assets ki 20. That's fine. During the year ended 31st March 2002, two machineries were sold for 10 lakhs. Sir, please make it 70 lakhs. It's printed as 10. Please make it 70. Yeah. 70, sir. Correction here. And the carrying amount of these machineries as on 31st March 2002 is 60. So end of the year he sold for a profit of 10 lakhs. A profit P&L it will be there. You have to eliminate that. Next, income taxes paid during the year is 105 lakhs. Is the actual tax paid. Using the above information of Kuber Limited, construct a statement of cash flows under indirect method. Other non-current / current assets and liabilities are related to operations of Kuber Limited and do not contain any element of financing and investing activity. What is the meaning of that is other current and non-current assets. That means go and see there. Other non-current assets, other current assets, liabilities also he told. Liabilities also. That means other non-current liabilities, other current liabilities. Four items ki don't have any inhibitions. All are relating to operating items only. And a point meaning is good. They are all working capital adjustments to adjust it off. See, other current liability increased or non-current liability from 3615 became 2740. Normally nothing is given. It's understood that liability is paid in the current year. When liability is paid, which activity? The financing activity. But he's clearly telling that they are all related to operating item. To working capital adjustments will include them. Naturally, whatever has to happen will happen there. That's all. This is RTP question, sir. Important. Nothing is there, but important. So anyway, what all data we need? First think of. Sir, indirect method gabati, you should start with profit before tax ideally. If you start with PAT also no problem, but ideally you should start with profit before tax only. He gave you PAT 4450. I want PBT. What should I do? I have to add back provision for tax expense. This balance sheet lo nowhere tax provision is not there. If tax provision is not there, whatever tax you paid, that only is also the provision. Somewhere lastly he gave you that you paid a tax of 105. 105 go and add it to 4450. So that will be your profit before tax. Up to here it's clear. Okay. Then depreciation and amortization. Look at the adjustments. E depreciation 500 non-cash, E20 amortization non-cash add back. So 520, 520 added back. This is straightforward. Next adjustment, sir. Machinery 60 lakhs, book value in machinery you sold it for 70 lakhs. There is a gain of 10 lakhs. Our gain 10 lakhs definitely will be there in your profit. That is investing activity. So remove 10. Then go back to the balance sheet. Already discussed while reading the balance sheet. DTA increased. DTA increased means in the current year you should have created a deferred tax asset. What is the entry you would have recorded? DTA to P&L you would have recorded, but there is no cash inflow for that. Future cash inflow tax savings today you recorded. So today cash inflow is not there, no. So remove it. How much gap, sir? 105. 105 you remove. Now whatever adjustments he gave here, all adjustments are over. ఈ బ్యాలెన్స్ షీట్లో డెఫర్డ్ ట్యాక్స్ అసెట్ రిలేటెడ్ అడ్జస్ట్మెంట్ ఓవర్. ఈ రిమైనింగ్ వాట్ ఎవర్ అదర్ కరెంట్ అసెట్స్, అదర్ నాన్ కరెంట్ అసెట్స్, అదర్ కరెంట్ లైబిలిటీస్, అదర్ నాన్ కరెంట్ లైబిలిటీస్, ఇన్వెంటరీస్, ట్రేడ్ రిసీవబుల్స్, వాట్ ఎవర్ ఆర్ దేర్, treat them completely as working capital adjustments. So let's start with one by one. So other non current assets to them, sir. First, last year 770, current year became 800. You imagine as debtors, sir, no problem. 770 became 800. Increase in debtors. Inflow no outflow? No. Outflow. How much? 30. 30 you show it as a outflow. Go and check it's matching or not. 30 outflow should be there. Okay, next. Then we answered about this one. No, this is over now. Next, coming to current. Current low, sir. 85 became 195. 85 became 195 means again debtors increased. Debtors increased is also a outflow. How much gap is this? 110. E 110 also is a outflow. 2 points over. Next, coming to other non-current liabilities. 3615 became 27440. Liability decreased means outflow. So how much gap is there? Check out. 875 outflow. Then other current liabilities you come, sir. From 200 it became 100. Liabilities increased means it's a inflow of 100. Don't forget this trade payable. Trade payable from 90 it increased to 150. 90 to 150, 60 rupees. That is also inflow. Check matching or not matching. Now bank OD is there. Don't touch that. Why? Good. Bank overdraft should be treated as part of cash and cash equivalents. Cash equivalents adjust చేసేయాలి, sir. Opening closing. Forget bank overdraft. There are a couple of other items which we left. Go to asset side. Top low, PP leave it, intangible asset leave it. Other financial assets current, sir. From 170 it became 145. So how much investments decreased, sir? Investments or whatever asset, I don't know. It has decreased. Imagine debtors decreased. If debtors decreased, inflow or outflow? Inflow. So this 25 also take it as inflow. With this, our operating items will be over, sir. Working capital adjustments. Last row tax paid you remove. You are done with cash flow from operating activities. 25, 30, 110, 875, 100, 60. Yes, everything is covered. Finally, tax you have to remove here. Answer ready. Now you see, here you might get a doubt. Sir, why to add back tax 105? Why to again remove here? What you are adding there, what you are removing towards the end, not same. What you added there is provision for tax. What you removed here is tax paid. Coincidentally, both are same. That's all. And now, sir, let it be. Somehow they are same. No, why to do that? Still you have to do because you have to display how much tax you have paid in the current year. For that, definitely you have to show tax as a outflow towards the end. If tax finally outflow cheyalante, finally or starting point it should be PBT. Starting only if you take PAT as starting point, that means tax is already deducted. No, sir. Again tax paid and I should not deduct it. Double effect outundi. So pakka add back cheyalsinde, sir. There is no option here. So don't apply your mathematical rules here. Adi presentation purposes lo taxes have to be disclosed like that. This is operating, sir. Now let's focus on investing. Come back to the balance sheet again. Sir, PP last year 12,500. Ledger account I'm trying, sir. 12,500. Closing balance is 13,000. Somewhere he gave you depreciation. Go and bring that 500 up. 500. Then you sold some assets having carrying amount of 60 lakhs, but you sold it for 70 lakhs. సో 70 lakhs ఇక్కడ రాసుకో, 10 lakhs ప్రాఫిట్ రాసుకోండి ఇక్కడ. దట్స్ ఆల్. బ్యాలెన్సెస్ ఇది ఆబ్వియస్లీ విల్ నాట్ టాలీ. And obviously it will not tally. That will be a purchase of assets 13,500 plus 70. 13,000 how much? 570 minus 12,510. 10? Yes, 1060 balancing figure, sir. This is purchase of machinery. Purchase of machinery, which activity? Investment activity. Go and throw it there. Sir, are you able to draw this ledger account? Sir, I am not doing this because this is too below your level. Can exam if it is above your level, suddenly you lose marks. Try to practice this. I am leaving it because you spent years on this and we don't have much time also. That's why core adjustments I am explaining. Wherever CA final range adjustments are there, any IPCC sums are, there's nothing in that. IPCC lo ee sum ki IPCC sum ki difference entante deferred tax and set IPCC lo undadu sir. Remaining anta same to same. Okay, PP is over. Intangible rent, sir. Intangible asset. Sir, you all can casually draw ledger accounts like this time pass. How much is intangible asset opening? 30. Closing is 50. Amortization, sir. 20. Okay. You sold anything? No. So balance it. 50 plus 20 is 70. 70 minus 30, 40. You purchased 40, sir. 40 should be there somewhere. Go and check. Sale of intangible asset. Unda, sir? Untundi. Next. Investments go. Current assets are somewhere investment heading is there. 2,500 rupees worth of investment last year became 2,300. Investment value, why will it reduce, sir? There are only two reasons. Either investment value might have fallen down and you booked a loss, or you have sold off. It can be either of that. Now, is samlo, sir, nowhere they told us that investment value has been written off, loss is booked, and they did not tell us. Since they did not tell us, I have to only presume that investment has been sold. But investment has been sold, and if I have to presume, that fellow should give me one more information. What is that? Sale proceeds he should give me. 2,500 to 2,300 is what? Cost lo decrease. But sale proceeds, he did not give you. Profit on sale of investment, not there. So you have to only force it to assume that cost K you sold. So inflow under investing activities will be only 200. But what is smart than that is, since under Ind AS, investments and all, we basically that too, అది currently betted, sir. Currently investments are there, అది పక్కా FETPL accounting అవుతుంది sir దానికి. The moment you do FETPL accounting, ఈ 200 loss you would have booked in PRL. అది non-cash item. I will go and add back under operating activities. That seems to be a more appropriate adjustment than what study material has done. Are you understand the logic behind this, sir? You see, the current investments are, current investments, generally investment in equity shares and all, you measure it FETPL. But FETPL, when you measure, loss will come. Our loss PRL you would have booked. Kana the non-cash item. So 200 you should add back in operating activities. This is my version. But study material, they have treated it as investing activity, assuming that they sold investment exactly for cost 200. Answer will not change. There also add, here also add. But anyway, let them have their fun. So that is about investments. I guess with that, investing activities is done. Coming to financial activities. Come to equity capital. Equity capital 300 same sir, no problem. Come to borrowings. From 5,000 it has become 2,000. 5,000 becoming 2,000 means long term borrowing repaid. How much, sir? 3,000. Not only that, that fellow shouted somewhere that in the current year you paid dividend 450. Our dividend is a outflow. That's all. Bank overdraft mutko, sir. Bank overdraft is part of cash and cash equivalents. You got 10, 12 marks. Half an hour, 25 minutes, you should be able to finish it off. Maximum. You see how they presented the answer. A ledger account 7 years, sir. Everything, a calculations he presented. Like how you do it on calculator. Like that only he did, and as it is he presented. Because me ledger account start చేశాను అనుకోండి సార్, it will take 40 minutes. A sum range 10 marks. So you should know where to cut down your presentation and workings. మనకు వచ్చి కదా అని రెచ్చిపోకూడదు సార్. Time also you have to see. If it is 16 marks question, neatly you have to do. Then if you don't do, you lose marks. Some nibatti, sir. See, all the study material, wherever consolidation questions are there, detailedly for each question, PP note, intangible assets note, goodwill note, like that for everything he started writing notes. Our notes of what will be there, parent asset is this much, subsidiary asset is this much, total is this much. Did we prepare any notes like that? Balance sheet directly we added up. Adi correct sir, time saving ki. You can't afford to have each line item ki working note. If you go on doing that, prima facie consolidation of 4 steps will be there. 4 steps doing one big issue first. And the first step both never tension. 4th step what we'll forget another tension. After that balance sheet will tally or not, as ultimate. This process if you bring in 10 note points for the sake of decoration, pakka balance sheet will not tally. You will somewhere lose the control on the sum. Don't do over action, sir. So that is about that. So this is question 190. Now coming to the last main aspect of the standard, which we did not discuss at all till now. Your favorite chapter, Consolidation Business Combinations, again came off. Oh, okay. Listen. Sir, tell me, purchase of investment, which activity? Quick. Investing activity. Purchase of investment in subsidiary, which activity? Still investing activity only. Nice. Now, when you buy investment in subsidiary, investment you will get. You will pay some consideration, no? A consideration what will be there? Chapters over, sir. Now tell Ganesh. Put in a sir, in the last row. Cash can be there. You can issue your shares. Deferred consideration, contingent consideration. All these are possible. Right. Now, whenever you purchase investment in subsidiary or whenever you sell investment in subsidiary, cash flow statement lo obviously only the cash component will come. For example, I purchase investment by issuing equity shares. Equity shares will come in here? No. Deferred consideration, will it come? Will not come. Only the cash component alone will come. So that only will show it under investing activity. Not a problem. But in your notes to accounts, you have to go and give a disclosure as to current year, I bought control in this company. I paid this much of PC. EPC, these are all the components. In this cash component is this much, and you have to go and give a detailed disclosure in the notes to accounts. It's important. Exam also. You should remember this. Cash flow statement lo what you will put is whatever cash component is there, that alone you should put. That means in this also one twist is there. Suppose you are A Limited. You not consolidation also, business combination, general example will take. B Limited company, you absorbed it. Imagine you paid to this fellow a PC of 5 lakhs. Entire 5 lakhs cash PC, sir. Purchase of business, which activity? Investing activity A. So this will go into investing activity, 5 lakhs outflow. But you see, E B Limited balance sheet low, so many assets, so many liabilities will be there. In that, imagine bank balance also is there, 80,000. You paid 5 lakhs for what? Entire business you paid. Our business low, cash is also there to the extent of 80,000. Ante sir, what is happening? He hand I gave 5 lakhs. He hand immediately received 80,000. Effectively I gave how much? 4 lakh 20. That you should report. So investing activities low, outflow will be equal to 5 lakhs minus 80,000, which is equal to 4 lakh 20,000 outflow jubichal, sir. That means whenever I acquire any investment or control over any business, PC paid low cash component, whatever I acquired, in that any cash is there, net of just jubichal, sir. So this is about investing activity. Next point. Sir, A Limited is there. There is a separate altogether new another company called B Limited. This fellow freshly purchased 70% shares in this company today only. Because he purchased 70% shares, he acquired control. So whatever PC he paid, EPC so many components might be there. In this, identify the cash component alone. A cash component alone, you must be reflecting it as investing activity, net of any cash and cash equivalents in B Limited. Same point, whatever I told you above, the absorption I told you, amalgamation type, this consolidation also, same principle. Same principle. 70% shares in your company purchased by paying you 5 lakhs. But nee balance sheet lo already cash 1 lakh ఉంది sir. Now I will do consolidation. Consolidation, what will happen to that 1 lakh? 1 lakh will come into my balance sheet. But from my balance sheet, prima facie 5 lakhs is going. Imagine consolidation entry. Go to consolidation chapter entry. When you date of acquisition key, consolidation books, what entry you will write is A1, A2, A3, to L1, to L2, NCA into NCA. All this you will write. To bank you will write. Right? E bank lo I paid 5 lakhs. Kani A3 also is bank account only. 1 lakh. What he is asking is, in consolidated cash flow, show net 4 lakhs as cost of purchase. Are you understand, sir? When I paid 5 lakhs, he hand the 1 lakh is coming, no sir. Effective 4 lakhs only you should show. This is where, sir, when you obtain control. Now take reverse case. A, B. This fellow is parent. This boy is subsidiary. A Limited sold all its investment in B, which was subsidiary, for some cash. And this is loss of control. So loss of control, what should I do, sir? What will you do? You sold investment. Which activity? The investing A. Now sale proceeds will be there. A pakka inflow. Suppose you sold all the investment for 10 lakhs. You sold now. When you sold, think in consolidation what will happen. In consolidation, whenever you lose control, what is the entry you write? You know the entry, no, derecognition entry you write. L1, L2, L3, NCA you also die. 2, A1, 2, A2, 2, A3. Now that I sold this, I will be receiving cash. Bank 10 lakhs I received. But A3 is also bank balance of subsidiary only 1 lakh which I am derecognizing now. Effectively consolidation point of view, what is the net impact on cash? 10 lakhs increase, 1 lakh decrease. Effectively only 9 lakhs. 9 lakhs jubichal sir. 9 lakhs only is your investing activity. Did you understand, sir? When I buy, the PC what I pay minus cash what I am getting, net PC you have to reflect. When I sell, whatever consideration I am getting and whatever cash which belongs to you, which I am derecognizing now, this renditke difference you have to show. Investing activity. Sir, all this might appear suddenly new to you, but you understand, link up the chapters, sir. Consolidation law, did we discuss this entry? Did we discuss this entry also? Acquisition date ki? Yes. A entry gurtupetukunte you automatically will understand, sir. Debit loan bank undi, credit loan bank undi. Automatically net off JCC, show the net effect there. Next. This one if you tell you are Pro Max, Ultra Pro Max. Sir, it A Limited, sir. This boy is B Limited. He already 60% shares he is having, subsidiary. Now, purchased another 10%. Cash outflow pakka ఉంటుంది, sir. You tell me, where will I show this? Consolidation accounting, you know. Consolidation law, existing subsidiary law, if you buy additional shares, it will be treated as equity transaction. Transaction with equity participants. Who are equity participants? NCA. NCA to transaction. So the entry what you basically will be writing is NCA to bank. Sir, do you remember this consolidation? We discussed this. Gain or loss unte we'll adjust it to retained earnings. That's a different thing. But entry. But consolidated cash flow jastundu sir. Consolidated cash flow statement. You tell me, e bank outflow where will I reflect? Very easy. You have only 3 choices, sir. Operating, investing, financing. Okay, angle allows investment I purchased, so it should be investing activity. But in another way you think, I paid money to NCA. Who is NCA? Equity participant, consolidated law. Equity participants you pay money, which activity? Financing activity. This is correct. No further control. Already control, sir. No further control. It is a transaction with NCA. This will be reported as a financing activity. Sir, the plain investment purchase, why will I ask you, sir? The NCA to transaction consolidation law. SFS law, obviously investing activity. Consolidation law, NCA you paid money. You did not get any control. Control already was there. You just increase your stake. అంటే గ్రూప్ పాయింట్ ఆఫ్ వ్యూలో ఇట్ ఈస్ ఎ కైండ్ ఆఫ్ ఎ బైబ్యాక్, isn't it? Shares are there with whom? NCA. What did our group did? Throw cash, purchase their shares, and we are holding their shares now. Our shares consolidation will not appear because we cancel it. Effectively, it is as good as a transaction with shareholders. Shareholder the transaction, why will it be investing activity? Financing activity. Same case, sale also, sir. I mean, ఏమా అంతే కదా, కంట్రోల్ చేస్తే మొత్తం ఇన్వెస్ట్మెంట్ చూపించుకోవాలి. ఎగ్జాక్ట్లీ దట్స్ వాట్ ఐమ్ టెల్లింగ్. ఈ 4 examples ka summary is that only. When you obtain control or when you lose control, then only investing. కంట్రోల్ అట్లాగే ఉంది సార్, ఇన్వెస్ట్మెంట్ పర్చేజ్, ఇన్వెస్ట్మెంట్ సేల్ అయితే ఫినాన్సింగ్ యాక్టివిటీ, యాజ్ సింపుల్ యాజ్ ఇట్. అదే కరెక్ట్ సమ్మరీ దట్ ఈస్. దట్స్ వై ఇన్ మెటీరియల్ ఆల్సో వి రోట్ లైక్ దట్ ఓన్లీ. లుక్ ఎట్ దిస్ 13th point. First heading you see classification of cash flows as investing activity. Next page heading you see classification of cash flows as financing activity. When investing activity అవుతుందంటే when there is a control obtained or control lost. Without change in control, if you simply change its stake in the subsidiary, financing activity. Read that. The aggregate cash flows from obtaining or losing control of subsidiaries or other businesses shall be presented separately and classified as investing activities. You see language you observe, obtaining or losing control. And without you purchase extra shares already subsidiary low, that will not fall under this category. You sold shares but still control is there, will not fall under this category. And next page lo kostam sir. And then you should disclose. He's talking about disclosure. In respect of both obtaining and losing control of subsidiaries or any other businesses during the period, each of the following. What all will you have to disclose? Total consideration paid or received, the portion of the consideration consisting of cash and cash equivalents, the amount of cash and cash equivalents in the subsidiaries or other businesses over which control is obtained or lost. What is this? When I buy a subsidiary, I pay 10 lakhs cash, but a subsidiary already 1 lakh cash is there. So what you will say is 10 lakhs outflow is there, but I got control on 1 lakh cash. 1 lakh also you have to disclose. The amount of assets and liabilities other than cash or cash equivalents in the subsidiaries over which control is obtained or lost is summarized by each major category. This is all assets what you consolidated, liabilities you consolidated or you derecognized, notes to accounts level, sir. Then the separate presentation of cash flow effects for obtaining or losing control of subsidiaries or other businesses as a single line items together with separate disclosure of amount of assets and liabilities acquired or disposed of helps to distinguish those cash flows from the other cash flows. All this is disclosure ka explanation, benefit is telling, not required, don't worry. E point alone you remember. The cash flow effects of losing control are not deducted from those of obtaining control. What is the meaning of this? One subsidiary you sold, another subsidiary you purchased. E cash flows net off chese kudu sir. Adi separate ga disclose, ఇది separate ga disclose. Two separate transactions. This is ultimately point you have to remember. The aggregate amount of cash paid. Cash when will you pay? Control when you are buying you will pay. Or cash received. When will you receive cash? Sell. Upon receive. Anyway, the aggregate amount of cash paid or received as a consideration for obtaining or losing control of subsidiaries or other businesses is reported in cash flow statement net of. Net of what? Net of cash and cash equivalents acquired or disposed as a part of such transactions, events or changes in circumstances. What is he saying, sir? I paid PC 10 lakhs. I got control over your subsidiary, but in balance sheet already 2 lakhs cash is there. Net I have to show only 8 lakhs. Similarly, I sold investment in your subsidiary. I received 25 lakhs cash, but because I sold investment, some derecognition entry I have to write. Derecognition your cash 2 lakhs is going away. 25 lakhs inflow, 2 lakhs outflow, net effect only 23 lakhs I have to report. On the point, you have to remember, sir. But all this is when, sir? When you obtain or lose control over other business, then only drama. Next, come to the next part. Cash flows arising from change in the ownership in a subsidiary that do not result in loss of control shall be classified as cash flows from financing activities unless the unless point is unless the subsidiary is held by an investment entity and is required to be measured at FVTPL. Why is he telling all that is, if subsidiary is held by an investment entity, that fellow anyway will not do any consolidation. For his no exceptions, no special treatments, normal treatment will apply. Anyway, change in ownership. So here important point is cash flow from financing activity. When change in ownership interest that do not result in loss of control. The example is telling change in ownership interest in subsidiary that do not result in loss of control, such as subsequent purchase or sale by a parent of subsidiary's equity shares, are accounted as equity transactions under IND AS 110. Our points and all you already know, sir. We are not discussing that. Whatever we have discussed, and go table is there. You can go through this chart later on. Same points, nothing like one point extra also will not be there. That's also. With this, officially standard is over, but questions are left. Exam low, subsidiary consolidation type questions important, sir. So don't try to run away. Focus. Come to question number. Where is this question? 15th one. This is bang on the same concept what we have just now studied. Literally same. So don't mess up at least. Company A acquires 70% of the equity stake in Company B on July 20, 2001. The consideration paid for this transaction is as below. 70% purchase of stake shares you paid, cash consideration 15 lakhs. You also issued some shares, 2 lakh shares, face value of 10, fair value 15 rupees. So the total PC you can work out if you want. On the acquisition date, Company B has cash and cash equivalent balance of 2,50,000 in its books of accounts. Stop there. Next point, need not read, that's a different case study. Answer now. Investing activity, how much will you show? Good. 12 lakhs, 15,000. How? 15 lakhs paid, 2,50,000. Your cash I got now, effectively 1250. Then why did he give you shares value? Trap, not trap. He is expected to say that you have to give a disclosure saying about what is the total PC I have paid. So total PC workout just disclosure lo royal sir. Next, on October 10, 2002, and some other year, the Company A further acquires a 10% stake in Company B for cash consideration of 8 lakhs. Further acquires means already B is a subsidiary. In subsidiary, he further purchased 10% stake. This is a transaction with NCA. NCA is who are equity shareholder of the entire group. So obviously this will be shown under financing activity. 15 lakhs less 2,50,000 will be shown under investing activity. And the 10% stake additional whatever you purchase must be shown under financing activity. Next, 16th one. So 16th one we got to solve. The two questions we have to solve in that 16th and one more. Okay. Entity A acquired a subsidiary entity B during the year. The current year you bought. Summarized information from Consol P&L and balance sheet is provided together with some supplementary information. So what is there in P&L? Let's see. Revenue 3,80,000 is there. Cost of sales 220 is there. Gross profit, depreciation, other operating expenses, interest cost is there. PBT, taxation. Consolidated balance sheet. Last year, current year. In that, cash, trade receivables, inventory, PPE, goodwill. Trade payables, income tax payable, long-term debt. And shareholders' equity, share capital is also there. Last year was 35, this year became 90. Other information. All the shares of entity B were acquired for rupees 74,000 in cash. So you paid cash completely and purchased 100% shares of entity B. NCA later, that's why balance sheet you can see. The fair value of assets and liabilities acquired are, ante B nunchi what all assets came in? Inventory, trade receivables, cash, PPE, trade payables, long-term debt, goodwill, effect and cash paid is 74. Actually, the net assets ekkada varaku sir. This cash paid, 18,000 is a kind of your balancing figure. He is asking prepare cash flow statement for the year 2002. Now, first observation, sir, investing activity lo what will you write? You can see an answer, one line answer. How much cash did you pay? 74. Did you acquire some assets and liabilities? In that some cash is there. How much is there? 2000. He hand to 74 I paid, he hand to I received 2000, effectively 72,000. Adi outflow chuvichal, sir. Are you clear here? Right. Now, ee sum lo this is one adjustment. Apart from this, only one extra adjustment is there. That extra adjustment is, when you do working capital adjustments, you should be careful. Reason is, 2 columns is given, no? Ee 2 columns lo, idi consolidated, sir. This is not consolidated. Why that's not consolidated? Sir, last year the subsidiary లేదు కదా, sir. So the normal plain, sir. Now if you observe, carefully think, sir. I'm not talking about this sum. In general, you think. Sir, debtors previous year, or else debtors, inventory example. Inventory previous year, 50,000, sir. Current year inventory, 70,000. You are doing working capital adjustment. You tell me, what is the treatment of this? 50 became 70. 20,000 inventory increased. Inventory increased because I purchased stock. Therefore, 20,000 is outflow, you will show. So, while doing working capital adjustments, increase in inventory, 20,000 rupees outflow, sir. In the you understood, no? Now you see the twist. I'm telling you, in current year, you acquired a business. When you acquired a business, so many assets and liabilities came. E assets and liabilities low, stock also came to the extent of 5,000. But a stock obviously is included in that. Then my answer will change or will not change. See, working capital point of view, if I ignore this transaction for a moment, 50 stock became 70, pakka 20,000 outflow. Answer is not wrong. It's not like 20,000 is wrong. But since there is a business combination transaction, if 5,000 is part of your business combination, that means, imagine, sir, suppose in PC, let us say you paid some 80,000 PC pages, sir. Now, if business, whatever you have taken over, in that, inventory, debtors, some investment, some PPE, some creditors, all these are there. In the inventory also there to the extent of 5,000. For all this, some net assets value is there. For all this only you paid a PC of 80,000. E process lo goodwill also came. In consolidated cash flow statement, what is the requirement of the standard? Whatever cash component you paid, that you show it under investing activity. Tell me, sir, is it correct for me to show 80,000 as outflow and also 5,000 outflow, debtors will increase outflow, even if it is, sir, won't it be a double effect? You observe, sir, if 50 to 70 increase low, if 5,000 is also one of the reason. Ante e 20,000 outflow, if 5,000 also is included as outflow. Do you agree with that? Sir, the very core point, sir, books lo no stupid will write this. Understand correctly. 50 to 70 inventory increase aithe, aa 20,000 lo, your acquired business ka stock is also playing a role. Yes or no? So, aa 20,000 increase, 5,000 is there or not? Yes. But a 5,000 with another name called as PC paid and I am reflecting in under investing activity. How can you again show if 5,000 under operating activity? Are you understanding, sir? This is wrong, sir. Double effect out, sir. E 80,000 low inventory also untun, sir. E 80,000 cash lo imagine you paid. This will be going under outflow for investing activity. When I write 80,000 outflow, 80,000 like 5,000 is there. Malli operating activities, adhe 5,000 you cannot show it as outflow. Same applies for all trade receivables, trade payables, whatever you acquired from subsidiary. So, rule is, current year when you acquired a subsidiary, nee closing balances lo, whatever assets and liabilities you purchase from subsidiary, you eliminate them. Then you do the working capital adjustments. But na correct effect kavalante em cheyali, sir? Ee 70,000 current year, actual balance sheet 70,000 untundi. How much stock did you acquire from the subsidiary? 5,000 తీసేయండి, sir. Remainder 65. 50 to 65. How much increase? 15. 15,000 you show. Sir, మరి 5,000, 5,000 another name to it will come as an outflow under investing activity, because that is not a stock which you purchased in the market, only stock. Adi business acquisition. There is a difference, no sir. Asset acquisition is different. Business acquisition is different. Business acquisition will become investing activity. Simply stock konukocharu sir, that is different. That will come here only. So our differentiation kosam ee sums lo ee extra twist will be there. So come back to this sum. Okay sir, look at this. Ee sum we can go through it, but next sum I have to make you do sir. One sum, easy sum sir. Ee sum came in the exam also. I predicted it and it came, same attempt, 10 rupees. Nobody will write you logics anywhere. Logic is sir. In whatever assets and liabilities you take over from the subsidiary, adi PC ane name to outflow lag you are showing under investing activity. Again, purchase of asset ane name to again you should not show it under operating activity. And then you have to remove it. Anyway, come to the analysis part here. Tell me sir, your starting point is what here? Profit before tax, 70,000. Observe, 70,000, prima facie you have problems with who? Always this fellow will be a problem. Who is that? Adjacent sir. Next. Interest cost also is a problem only. Why interest cost is a problem? And interest cost will be treated as a financing activity. So 70,000 you take, add back 30, add back 4,000. Now, nothing else is problem in the P&L. Come to balance sheet. E balance sheet lo, I have to do working capital adjustments. Working capital adjustments ki, observe here, 50 became 54. But in the current year balances, subsidiary you have acquired, that also will be there. Don't compare 50 and 54 directly. Sir, what should I do, sir? 54 first you remove whatever you took over from subsidiary. How much trade receivable you took over from subsidiary? 8,000. 8,000 trade receivable remove sir first. 54 minus 8. How much is that? 46. So 50 became 46. Debtors decreased. Inflow, outflow. Inflow. How much inflow? 4,000. 4,000 bit call sir. So like this. Come to other items as well. Next sir, inventory. Today closing inventory is 30. How much inventory did I buy from that fellow? 4. 4 first you remove from there. 30 minus 4. How much is that? 26. So 35 inventory became 26 inventory. 9,000 inventory. 9,000 is inflow, outflow. Inventory decrease, no, inflow only. Next. PP is not here. Forget about goodwill also. Trade payables. 60 became 68. But a 68 low. 32. Oh wow. So 68 minus 32 if you remove. 36. 36. So 60 liability became 36. 24,000 outflow which calls sir. E3 adjustments sir. Remaining all sum is just like any other sum. Go to investing activity and see. 72,000 వచ్చింది. ఇది already you told me. Sir, మరి ఈ whatever 8,000, 5,000, 32,000 adjustments you did, మరి where are they reflected? Where are they reflected? ఈ 72,000 everything is there. ఈ 72 who are all there? ఈ list completely is there. ఈ list లోనే 4,000, 8,000, trade payable 32,000 everything is there. Apart from this who are there? Okay, this is okay, you understood. Apart from this who are there? Cash. That already PC లోనే adjust చేసాం sir. So forget cash. Apart from that, PP, long term debt. Normally, PP when you buy, which activity? Loan also, investing activity. Loan if you take, financing activity. But here, asset individually you are not buying, loan individually you are not taking, you are buying it as a business combination. It is totally investing activity. Not only PP, goodwill or long-term debt, every item, inventory, trade receivable, cash, everything will become investing activity because control you are obtaining on a business. Since our 72,000 everything else is there, operating activity they should not be there. And then we removed it. Financing activities lo interest paid is there, that he removed. That's all sir. He adjustments he did. See here working notes lo closing inventory he took. From that inventory acquired during the year. It is very important sir. You must not by heart these adjustments and do it for every consolidated financial statements. This drama, why is it happening ante current year lo subsidiary acquired, last year SFS, current year is CFS, comparison problem will come. So you remove it. So closing balance nunchi first you remove this, then you do the comparison. Okay, last sum, sir. No, sir. After this sum, cash flow statement is over. You are going to stay. You have one more sum, huh? Evening also will do. The relevant extracts of consolidated financial statement. So somebody is getting late for office just for today. Kindly stay back. Hari, sum is over. We'll go on. I didn't get you. ఈ సమ్ అయిపోయిందని చెప్తున్నా కదరా. ఓహో, నీకు వేరే గోల్ ఉందా? The relevant extracts of consolidated financial statements of, his name is Rajendra, sir. If somebody doesn't know. The relevant extracts of consolidated financial statements of A Limited are provided below. Sir, ఇది consolidated balance sheet, sir. ఇంకేం చెప్పంటావా? ఫోన్ నెంబర్ ఇస్తాను. Okay, sir, last year data, current year data is given for PPE, investment in associate, financial assets, inventories, trade receivables, cash, current liabilities, trade payables. It's not full balance sheet, extract another, extract it. So next coming to P&L. 12,380 revenue, cost, GP, other income, operating expenses, other expenses, interest expense, share of profit of associate, and profit before tax. The below information is relevant for A Limited Group. Sir, is sum is a lengthy question, but there is only one requirement. He will not ask you full cash flow statement. Only operating activities cash flow. Sum will be small only, but question is huge. You got to go through it. Important, sir. We are going to solve it, not see and leave. So mentally get prepared and read. A Limited has spent rupees 30 lakhs on renovation of building. A Limited charged the entire renovation cost to P&L account. Sir, renovation cost treatment in, sir? You have to capitalize it. This fellow charged it to P&L. Ante not only cash flow adjustment, and profit also is wrong. Rectification error is also there. But you know what to do. Next. On 1st April 2001, the year beginning, A Limited acquired 100% shares in S Limited for a cash of rupees 300 lakhs and the fair value of assets acquired and liabilities assumed under acquisition are as under. Oh, wait there. When did you buy shares? Current year lone, first year. Ante current year lone what now? The moment current year lone you buy, look at that balance sheet. Our balance sheet lo current year closing balance sheet whatever is there, adi consolidated. Last year compared to what they gave, adi without consolidated. So, close whenever you do working capital adjustments now, closing balances lonchi whatever assets you have copied from subsidiary, you remove that, then you do working capital adjustments. See, one point if you remember is somehow nothing is there. Okay, what are all you acquired? You see, PP you acquired, inventory 60 lakhs. Inventory will have a consequence for us. Trade receivable, cash and cash equivalent, and trade payables. Now PC, how much did you pay? Once again, go back and see. 300 lakhs. 300 lakhs PC base, all this came. Process like cash also came. How much? 20. 300 I paid, 20 I received. Effectively, 280 investing activity you have to show. Next, third point. A Limited's PPE comprise the following. Opening carrying amount is 4650. This you can verify in the last year balance sheet also. What happened to that? Current year additions. How much additions did you make? 800. 800 including 140 also. Including assets in S Limited. Ante 800 lo 140 kakunda other is how much? 660. That you must have purchased in the current year. Not only that, our buy also revalued this. Then he sold something. Then depreciation he provided. Closing carrying amount he gave us. Okay. In this, where you should be little careful is, our depreciation amount to P&L also it is there, not there. It is not there specifically anywhere, P&L. But depreciation is included. Operating expenses somewhere you would have, or cost of goods somewhere you would have included. So our depreciation you have to now add back, sir. Asset disposed on gain or loss, we'll see. A Limited constructed a machine that is a qualifying asset. Nice. And incurred construction cost of 40 lakhs. Good. That has been charged to other expenses. Bad. Sir, machine construction cost, you will put it in P&L, sir? No, but this fellow put. So you have to add it to the cost of the asset and add it back to P&L also, because P&L is wrong prima facie. Of the interest cost 110 lakhs charged to PRL, you can see back it's 110. 10 lakh includes interest cost on specific borrowings that needs to be capitalized. So your profit is again wrong to the extent of 10 lakhs. PPE and equipment was sold at 630 lakhs. Wow, here he gave. Book value of asset sold is how much? 490. Actual sale price at which you sold is 630. That means how much gain, sir? 140 lakhs gain is there. Again, on disposal is adjusted against operating expenses. And P&L lo you have recorded 140 lakhs gain. Only thing is, instead of showing it as income, you netted it off as expense. Either way, the income only. So while handling your cash flow from operating activities, you should eliminate this. Next. Apart from this, A Limited purchased 30% interest in Associate G Limited for cash on 1st April. Subsidiary over associate gone, sir. The associate reported profit after tax of 400 lakhs and paid a dividend of 100 lakhs for the year. Oh. So, sir, why associate ka profit he is giving, you know? Equity method you apply. When you apply equity method, associate ka profit, your share will copy into your P&L. Go and open that fellow's P&L. Did he record 120? Go and check there. 120 asset, sir. But 120, will you get any cash? You won't get any cash. While doing cash flow from operating activities, 120 you have to remove. Sir, you know what is the trap in this? Not 120, a dividend trap. Dividend that fellow paid how much, sir? 100 lakhs. 100 lakhs, so you would have received how much? 30%. 100 into 30%? 30. You would have received that. What accounting you would have done for this? Associate, sir. Fantastic. Associate equity method lo, when associate declares dividend, a dividend P&L lo I go, sir. That should be reduced from the investment. Why are you reducing from the investment? Even before that fellow declared dividend, his entire profit only already copied. Out of that profit only, if he gives you a small biscuit now, that is not a new income. That already recorded income. Investment you have to reduce. Ante P&L you will credit or not credit, you will not credit. When you did not credit to P&L account, removing that question only will not arise. Are you understand, sir? If you wrongly think that your dividend has gone to P&L while doing cash flow from operating, I will remove that into gone sum. Our standards, if you know very well, each standard you can handle. Time spent is investment, sir. All that standards, all that examples, they all will help you. Final story, last part. Impairment test was conducted on 31st March 2002. The following were impaired. Goodwill impairment loss is there, it seems. And then there is an intangible assets impairment loss, 900 lakhs. Very good. Then the goodwill impairment loss relates to 100% of the subsidiaries. Very nice. All these points why he gave you is both are non-cash. So simply have to add back them. Assume that all the interest cost is paid in cash. Doesn't matter whether it is paid or not. Why it doesn't matter is, anyway financing activities, sir. Whether it's paid or not, who cares? Anyway, I'll add it back. You are required to determine, question is only this. Cash generated for operations. That's it. Quickly, sir, in your notes. So I'll just take 8 minutes. Question number, sir? 17. Right. First problem with this question is that stupid, whatever profit he gave, a profit, wrong profit. Calculation of correct PBT. Profit as per P&L given. You do one thing, sir. You don't think. Simply copy paste. And anyway, you are doing that only. So you should be happy only, no. Renovation and construction costs wrongly debited to PRL. I'm not doing cash flow statement, just for reminder. PBT mistakes I'm correcting. How much is this? 30 and 40 both 70 total. Not only this, borrowing cost eligible for capitalization adoko 10 lakhs. So 1840 plus 80, 1920. This is your corrected profit before tax. That is good enough for us, sir. You can start with statement of cash flows flow, operating activities. Associate company का dividend will not be recorded in P&L account when you are doing consolidated books, because that fellow's profit is already recorded in P&L. Out of that profit only, if he is again paying you dividend, that won't become a new profit, no? So, yes, sir. I didn't get you. Let it include, no? That's correct only, no? అది cash flow statement lo, sir. See, I am not doing cash flow adjustment. Working note number 1 is 1840 profit, wrong profit. First I am working out correct profit. Once you work out correct profit, then I will translate this into cash flow from operating activities. Don't do profit removal and all in that. Adi cash flow lo you have to do. Ivi rectifications, sir. These are mistakes which you are rectifying now. Cash flow rectification చేసి చేయకూడదు కదా సార్, కొన్ని క్యాష్ ఫ్లో చేయాలి. సో ఎనీవే, ప్రాఫిట్ బిఫోర్ ట్యాక్స్ 1920. To this add depreciation. Depreciation on the face of P&L he did not give you, but working note he gave you. Go and check. Depreciation is 290. Then similar items are there. Impairment of goodwill is there, 265, book that. Then similarly, they all belong to one family called as non-cash items, 900. Then as he told, remove profit on sale of PPE. Go and check at what rate did you sell and all. 630 ka, 630 minus 490, 140. It already included in profit. First 3 items belong to a family called as non-cash. Fourth one is cash, but non-operating. Add back. Interest expense. Idi cash, but non-operating. How much interest expense? 100. Sir, why 100, sir? 110 lo 10 already we added back above only while rectifying the profit. So correct interest expense is 100. That also I will add back now, not because it's a mistake, but because it is a non-operating item. Net off up to here, sir, please. Wait. One more. Yes. Share of profit from A Limited, 120. That actually can work out and show also, or already see from the P&L. Now you work out, sir, because except working capital adjustments, rest all you should do. Mm-hmm. 3215. Okay. Now go and do working capital adjustments. Working capital adjustments, so where you should be careful is subsidiary related assets and liabilities, whatever are there, should be careful with that. Inventories, current sir. Inventories compared to last year inventory 1900, current year inventory decrease. Asal first of all in 1900 and 1550 should not be compared because of 1550 lo what is secretly hiding, sir? 60 is there. A 60 ni first eliminate chesi then you have to compare. Okay, sir. Right. Decrease in inventory. You write exactly like how I am writing. Last year inventory is 1900 minus 1550 minus 60. This you put it in normal brackets. Now you do the comparison. Ante 1490 ante 510 na 410. This is add on, decrease in stock, inflow. Next, sir, after inventories, trade receivables also decreases there. If you are able to understand like this, working note also again separately not required for this. Here only you can carry on. Debtors last year 1800, sir. Current year 1250, but at 1250 is a tainted number. At 1250 low, trade receivables which we purchased in a business combination is 30. 30 pakkan metti, then you compare 1220. How much is this? 580. 580. Decrease in debtors also is a inflow. Trade payables also there, sir. Trade payables also decrease only. Nice. Decrease. (3610) minus 1550. E1550 low. How much trade payable did you buy from that fellow? 50. So 1500 happens. So the 1610 now. How much is the answer? Okay. Inflow and outflow. Liability decrease means paid and outflow. Outflow. Tax paid is not there in this sum, sir. If tax paid was there, finally payment of tax also you have to compulsorily show. It's not there. Not there, but leave it. This is the answer. 20. That's all. This will be your cash flow from is some market important, sir. Previous sum also market important. These two sums are important. You must understand adjustments whatever I did here, this I did because acquisition happened in the current year. If acquisition already happened in last year, then last year also consolidated they will give you, current year also consolidated they give you. The increase or decrease in debtors, creditors, stock and all, our group assets. For that you should not do an adjustment. Normally only you do. These two sums low acquisition happened in the same year kabatti adjustment. Next, associate dividend is not there in your P&L account to be removed. So it was never there, will not remove also. That's all, guys. If you have copied, you can leave.